Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world. And yeah, let's just say this latest report from ScanTech AI Systems Incorporated has a few surprises in store for us. It's an amended report, folks, so you know something went a little sideways. So what happened here? ScanTech AI Systems Incorporated, who you might know as the company developing those computed tomography scanning systems for security checks. Well, they had to amend their last quarterly report. Why, you ask? Because they needed to fix some accounting errors. This is like finding out your math homework had a few mistakes and you have to redo it. Now let's talk about why they had to restate things. They recognized expenses for shares they plan to give out later. They also moved some costs around, moving some expenses from de-SPAC transaction costs to general and administrative expenses. Think of it like reorganizing your closet, moving clothes from the special occasion bin to your everyday wear pile. Basically, they also corrected how they accounted for shares pledged as collateral, which is a pretty big deal. Alright, let's dive into the numbers. Looking at their balance sheet as of the 31st of March 2025, ScanTech AI had about $771,000 in cash. That sounds decent, but then you look at their liabilities and wow, their total current liabilities were over $37 million. That is a massive gap between what they owe right now and what they have on hand. Their accounts payable alone were nearly $5 million. On top of that, they have a lot of accrued expenses and interest payable to related parties, which is a big red flag for me. It shows they are relying heavily on borrowing from people connected to the company. They also list security pledged to creditors in the form of common stock worth over $1 million. This means they've put a significant amount of their own stock on the line to get loans. If things go south, they could lose a lot of that stock. Now, onto the income statement for the first quarter of 2025. They reported revenue of about $346,000. That is positive. Some income is better than none. But their cost of goods sold was $244,000, bringing their gross profit to just over $101,000. That is not a lot. The real kicker though is their operating expenses, which were a staggering $15.7 million. That means they are spending way more than they are earning. A huge chunk of that $14.7 million went to general and administrative expenses. This is where things get really interesting. A big portion of this increase is because they had to pay out $10.4 million in non-redemption compensation expenses. Basically, they are paying existing shareholders extra to keep their shares after some business deal. This is a huge cost and frankly a sign that they are struggling to keep investors happy with the company's performance. With those massive expenses, it is no surprise they reported a loss from operations of over $15.5 million for just 3 months. And when you add in other expenses like interest and changes in fair value of liabilities, their total net loss for the quarter was almost $17.9 million. That's a lot of red ink. However, there is a glimmer of good news buried in the other income section. They reported a gain of $6.4 million from the extinguishment of debt. This means they managed to get out of some of their debt obligations for less than what they owed, perhaps by giving up more stock or something similar. This is a common tactic for companies in financial difficulty, and with that net loss, their basic and diluted loss per S-share was negative 77 cents. That shows how much each share is losing value. Looking at the statement of shareholders' deficit paints an even clearer picture. Their accumulated deficit is over $202 million. This means over time they have lost far more money than they have ever made. They also have shares to be issued listed as a liability, a staggering $20.7 million worth. This means they have promised a lot of stock that they haven't actually handed out yet, and this obligation is showing up as a debt on their books. Their total shareholders' deficit is negative $50.5 million. This means the company technically owes more than it owns when you consider the value of the shareholders' stake. It is a significant negative number. You'll also see entries about a retroactive application of recapitalization. This is a fancy way of saying they are redoing their books from the past to reflect a major change in how the company is structured. This often happens after big deals like the business combination they had. It's like going back and rewriting history to make it fit the new story. The company has been busy converting debt into common shares. This is a way to reduce their debt burden, but it also adds a lot of shares to the market, potentially diluting existing shareholders. They added over $1.9 million worth of shares just from converting debt. They also settled accounts payable by issuing over $1 million worth of shares. This is another sign of financial strain. They are using stock to pay off their bills. It is an exchange for immediate cash flow, but it can hurt existing shareholders in the long run. Remember that common stock pledged as collateral? Well, here it is on the balance sheet, worth over $1 million. This is a very real asset that is at risk. Now let's revisit that restatement. The company is saying they found multiple errors. They corrected how they treated compensation expenses for those non-redemption shares, reclassified some expenses, and adjusted revenue and cost of goods sold. They even corrected how they presented those pledged shares. It is a lot of tidying up, and it shows that their financial reporting processes are not as robust as they should be. Their total liabilities as of the 31st of March 2025 stand at over $55 million. This is a huge amount for a company with only about $771,000 in cash. And notice that interest payable to related parties, it is over $330,000. This means people connected to the company are lending them money and charging interest. While this can be a source of funding, it also raises questions about potential conflicts of interest. They issued over $300,000 worth of stock for cash. This is a direct injection of capital, which is good, but it comes with dilution for existing shareholders. Here is something really important. The company itself is admitting there is substantial doubt about its ability to continue as a going concern for at least a year. This is a serious warning that they might run out of money. They have low liquidity and way more current liabilities than current assets. They are heavily relying on advances from Seaport Group SIBS Incorporated, and if that stops, they could be in big trouble. Despite some recent cash infusions from loans, their overall financial health is very precarious. They need to raise a lot more money or dramatically improve their operations to survive. To sum it up, ScanTech, AI is in a tough spot. They generated some revenue, but are spending far more than they earn. Business combination costs and compensation expenses are huge. They have converted a lot of debt into stock and still owe a lot of money. The fact that they're admitting serious doubt about their ability to continue as a going concern is the most critical takeaway here. They need a serious turnaround or more significant funding to stay afloat. What do you all think about ScanTech AI's financial situation? Did they make the right moves with these restatements and debt conversions? Let me know your thoughts in the comments below. And if you found this in-depth look at their 10Q filing helpful, please hit that like button. It really helps us out, and of course subscribe for more decoding of these complex corporate documents. Don't forget to join our Discord community linked in the description for even more exclusive content and discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.